Welcome to Market Wrap number 112. Stuart Williamson here at the helm. With the darkening economic clouds over the UK at the moment, this week we're going to look at one way the Bank of England is trying to help the UK residential property market and help more people get on the ladder. We recently reviewed our stats here at Market Wrap and we found that 74% of people who are watching are subscribers. So if you are, please like and do smash the like button. If you're not, please do subscribe and help us share the love. Bank of England regulatory change to boost UK house prices by 5%. That's our title. Back at the end of May, you may remember we recorded in the Market Wrap that the Bank of England was in the process of reviewing mortgage affordability stress tests to which borrowers in the UK have been subjected since 2014 post global financial crisis. At the time we reported that this relaxation would provide some additional medium-term capacity for house price growth. But the extent to such additional growth would be dependent on the timing and the nature of the reform and constrained by underlying limits on lending at high loan-to-income ratios and the ongoing need to adhere to responsible lending rules. The decision to do away with the most stringent form of mortgage affordability stress testing from the beginning of this month has led to many, notably Savills, Oxford Economics, the Financial Times, Royal Institute of Chartered Surveyors, to increase their forecast for UK house prices over the next 5 years. Today we're going to look at Savills research, and their projections have suggested that overall house price growth for the UK over the next 5 years could go up from 12.9% to 17.4%. And this is despite some headwinds that we're currently facing in the UK economy. They say that loan-to-income ratios will be restored to the levels seen at the end of 2021. Firstly, let's just look at Savills' current UK mainstream forecasts and assumptions. As you can see, Savills have only changed their expectations for price growth from the end of 2023, and this is on the basis of the squeeze on household finances from inflation and increased cost of debt or lending is likely to slow house price growth substantially over the coming months, with the prospect of modest price falls next year. But they counteract that by saying prices will continue to be underpinned by the shortage of stock available on the market over the course of 2022, despite there being more caution from buyers. And we're seeing that certainly at APW Towers. Savills do stress that additional capacity for house price growth from 2024 onwards is predicated by an assumption that bank base rates return to 1.75% over the next 18 months, which is what we reported last week based on interest rate swaps. Even if they're increased to a higher level in the short term, this short-term increase scenario is now looking very likely, with changes from the Bank of England's Policy Committee very shortly. The mortgage affordability and average loan-to-income ratio charts here show the effects of deregulation. This chart shows affordability for the average household buying the average home. We then go on to a sensitivity analysis showing the affordability of mortgage payments as a percentage of income, i.e. how much you're spending on your mortgage. And finally, in this chart, we see high house price growth to Q4 2026 with differing projected interest rates and the likely outcomes of those interest rates on growth. These are their views, and obviously they do have some skin in the game. It's important for them to try and talk the market up, but it's not just Savills, it is the FT and RICS and the like who are doing it. If rates were to end 2026 at 2.25%, that would negate any increase in price growth capacity unlocked by the changes in mortgage regulation, i.e. if it's not 1.75%, if it's 2.25%, there'll be no increase, it'll just be flat again. Obviously this comes with some realistic caveats in its current uncertain economic world, and with inflation looking likely to be higher for longer in the UK, it seems to us at APW Towers that these regulation changes will help support the market just to minimise downside as opposed to helping it rise. So I think this 25% growth or whatever it might be over the next 5 years is a bit high. We'd expect flattening for more than 1 year. Underlying mortgage affordability would be pushed up towards 2007 levels in the event the prices rose in line with Savills' forecast and rates ended the forecast period at perhaps 3.75%. Underlying affordability would be stretched, but not to the same degree seen in the early 1990s, when it was the primary cause of the house price correction at that time. The global financial crisis is not on the same page as this, or as 1990s. The impact that this would have on the remaining affordability tests conducted by lenders would substantially eat into the capacity of the 5-year house price growth, so that higher interest rate, that is. From a regional perspective, Savills believe more of the upside will be felt outside London and the South East. This reflects its restricted capacity for loan-to-income ratios to be pushed towards 4.5 times loan-to-income limits in the capital and its hinterland, where it's already very high. No more than 15% of a mortgage provider's new lending can occur above this level. If you take a look now at the mainstream capital value forecast below, you'll see that all areas but the south and the southwest would potentially be beneficiaries of Savills' new scenario. Finally, as the UK worries about its financial situation, this week I've been working with some expatriates based in Argentina, and you should spare a thought for them. Interest rates are currently 42.5% and inflation is at 65%. The UK's troubles pale into comparison. So this week we're taking a view of what may happen with this stress testing being relaxed from the beginning of this month. Savills will put their view across that they think it could well help support the market to grow by up to 25% over the next 5 years, with a caveat that interest rates may go higher and we may not have that possibility. Either way, compare property to other asset classes and it is one of the better, and you can gear against it, which you can't do with many others. Thank you very much. Don't forget, do like and subscribe if you can.